Welcome. Today I'm going to introduce the Accounting and Governance Risk Model developed by GMI Ratings, a quantitative model designed to organize firms on the transparency-opacity continuum in order to predict public company accounting fraud. Let's start with our agenda. I'll discuss the history of fraud detection by GMI and the motivation behind creating a model to predict it. In that discussion, I'll include a concise definition of the differences between forensic and fundamental analysis, how a model to detect fraud must make use of metric operations and peering rather than ratios, and finally, the details on how we built the Accounting and Governance Risk Model, or AGR. Let's start at the beginning. And for our purposes, the beginning is the year 2002, a period I refer to as the fraud epidemic apocalypse. We can all remember that period where we saw Enron, the 7th largest U.S. public company, disappear because of accounting fraud, as well as many others like WorldCom, Tyco, HealthSouth, Global Crossing, Adelphia, and many, many others. And the impact was dramatic. We saw NASDAQ go from 5,200 down below 2,000, trillions of dollars lost in the stock market, millions of jobs lost, and one more thing. We had to change a colloquialism. The Big Five accounting firms went to the Big Four when Arthur Andersen was shut down due to its role in some of the big-name frauds, including Enron. In many ways, this fraud epidemic was in fact the catalyst and motivation behind the creation of the AGR model. As we set out to create a model that could predict fraud and identify meaningful, opaque behavior, we learned early on the difference between fundamental and forensic analysis, and how fundamental analysis failed the world in this area. Now, don't get me wrong, fundamental analysis is immensely important, not to mention difficult. But there's one core underlying assumption in fundamental analysis, which simply stated is that the numbers reported on the financial statements, the MD&A, and the footnotes are accurate and reliable. That assumption failed to be true in 2002, and even today, academic and private research demonstrates it's not true anywhere from 15 to 50% of the time. Forensic analysis, on the other hand, takes one step back and asks, in its simplest terms, are the numbers from the financial statements potentially inaccurate and unreliable? I'd like to present a slightly contrived, simple, yet illustrative example of the difference between the two types of analysis. We see this table here. Let's pretend we live in a world where there are only 5 companies and they're identical in size, in product, and even in revenue. This implies that whichever of these companies is the most profitable is based exclusively on the quality of management. In this table here, we can see 5 companies, each with $100 in revenue, selling the exact same widget. The difference, however, can be seen in their gross margins. It appears that the firms are different in their production efficiency. Now, if we had to build a 4-company stock portfolio out of these 5, knowing only this information, it turns out that a fundamental and forensic analyst would exclude exactly the opposite company. Given only this information and nothing else, a fundamental analyst would look at the data and likely drop company E, as they do in fact appear to be the least efficient in their operations. They have the lowest gross margins. Interestingly, from a forensic point of view, it's actually firm A that is the anomaly. It turns out that firms with unusually high gross margins relative to peers, and of course some other details which I'll discuss later, are the firms that most closely mirror prior fraudulent companies. This would be an expense recognition game in our taxonomy, another detail which I'll discuss later. So even in this contrived example, we see that the forensic analyst would exclude company A, while the fundamental analyst would exclude company E. Now let's move forward and learn how GMI created the AGR model. First, after looking at the fraud epidemic of 2002 and meeting with experts in the area of accounting, we realized a couple of things. First, there was a lot of data to look at, and we had to find a way to find the most useful information, eliminate noise, while not missing the needle in the haystack. In all, we have examined nearly 500 million data points since inception of the model. Second, if we wanted to identify the fingerprint of fraud, or really the multiple fingerprints of fraud, we would build our model on a definitive source, and that source was the Securities and Exchange Commission. The AGR model is built on SEC enforcement actions of accounting fraud exclusively. As we dug into the first step of big data, we quickly recognized that simply looking at ratios was not the answer. At GMI, we call ratios metrics, but the model is not built on metrics. It's built on metric operations. Examples of governance and high-risk event metric operations are executive insider stock sales over total equity. Then we look at the trailing 12 months and compare it to our peers. The number of officer changes over the trailing 12 months and compare it to peers. Something like CEO and CFO incentive divided by their annual compensation. Look at the number of interquartile ranges, that is, from the industry median. Examples of forensic accounting metric operations would be accounts receivable over sales, but we would look at the 2-year volatility using the error term from univariate regression, then compare that number relative to its peers. Or we would look at the 1-year change in that metric and compare that relative to peers. Or we would look at the current period industry comparison and the number of interquartile ranges, that is, from the median. Here are some examples of some other forensic accounting metrics. The key to understanding this step of the process is twofold. First of all, to understand the idea that the metric operations are in fact little learning algorithms in and of themselves. The second is to understand the peering that GMI has done. We have developed a proprietary peering system over the last 12 years, which allows us to compare companies to like companies, but also allow us to take larger scale comparisons, for example, comparing Apple to Citibank, and yet still come up with relative comparisons that are meaningful. With the metric operation and big data organization in our mind, we next realized that we needed a taxonomy that was different from that of the financial statements. Accounting fraud is determined by a type of game, a fraud game as it were, and creating a proper taxonomy to categorize these games was essential. The AGR taxonomy has 2 meta-categories, each with subcategories. Forensic accounting has a revenue recognition portion, an expense recognition portion, and an asset-liability valuation portion. Forensic non-accounting has a corporate governance section and a high-risk events section. In fact, to this day, more than a decade after AGR was introduced, if you go onto the GMI Analyst application, you'll see this identical taxonomy still in place. Here's a snapshot from a random company to the right. Note the 5 categories within the taxonomy: corporate governance, high-risk events, revenue recognition, expense recognition, and asset-liability valuation. With a taxonomy and a systematic metric operation approach in place, we next had to determine which of these operations in fact had a strong relationship to fraud. We started with a univariate analysis and reduced our repository of 360 forensic accounting and governance metrics operations one at a time. The univariate measure we used is called the Summers' D. It's a non-parametric statistic designed specifically for univariate analysis, and it turns out that the newest academic research shows us that the confidence limits for Summers' D and their differences are in fact more informative than the traditional practice of reporting only p-values. Or in English, Summers' D is more informative than using odds ratios, correlations, or tetrachoric correlations. Using the Summers' D, we found about 100 of our metric operations that were statistically associated with fraud. They broke down into about 3/4 forensic accounting and about 1/4 forensic governance and high-risk events. With the univariate analysis completed, we then turned to a multivariate step to complete the AGR model. First, we combined the 100 metric operations into one of 2 groups, either forensic accounting or forensic governance and high-risk events. Finally, we applied a logistic regression on these rolled-up scores to apply a proper weighting on the accounting and governance factors. The result is a score transformed into a sigmoid, or an S-shaped function. The companies that fall on the upper right-hand side have the highest likelihood of fraud, and the companies that fall on the lower left-hand side have the lowest risk of fraud. One of the characteristics of a sigmoid output, if the model works properly, is that the tail behavior, so the really low-rated companies versus the really high-rated companies, have a very large disparity. In English, when the model is applied, the worst rated companies should show a huge proportion of fraud relative to the best rated companies. It turns out that AGR is good at what it set out to do, and it's actually good at a few things we suspected it might also be able to do. With respect to SEC enforcement actions of accounting fraud, we can see in this chart that if we group AGR ratings by decile, the worst rated 10%, the red bar, represent nearly 31% of all SEC accounting frauds, while the best rated companies, this green bar, represent only 2.8% of accounting frauds. The top to bottom ratio is 11:1. Again, in English, the worst rated companies by AGR are 11 times more likely to face an SEC enforcement action of accounting fraud than the best rated companies. Also, if we take the bottom 20% of companies, these right here, we find nearly half of all the frauds. GMI also has multi-factor models that incorporate AGR as an input. Two of these are the class action litigation model, which shows a top to bottom ratio of over 50:1, or in English, the worst rated companies by class action model are 50 times more likely to face securities class action litigation than the best companies. The second is a financial distress model, or more simply stated, a bankruptcy model. The uniqueness of the AGR financial distress model is that it incorporates not only the fundamental measures of distance to default, but also the possibility that the reported numbers are inaccurate and unreliable, making it a much more comprehensive examination of bankruptcy risk. Finally, AGR is also a good predictor of Black Swan drops, those stock drops of greater than 60% over a 6-month period, or greater than 40% in a single month. A more sophisticated Black Swan model is also available from GMI. This concludes our introduction to AGR. You can find contact information either via phone or email on this slide in yellow. Thank you for your time.